Good morning. Good morning, everybody. My name is Brian Van Hook, and I'm Regional Director of the Florida Small Business Development Center at FIU. I just wanted to welcome you to this really great webinar focusing on managing your cash flow. It's presented in partnership with the Miami-Dade Chamber of Commerce and a number of other sponsors. We're going to give it a minute or two for everybody to stream in. So get your coffee, get your tea. And then when we come back, we're going to turn it over to Matthew with the Miami-Dade Chamber for some remarks on their behalf. And but we promise we won't talk a lot because we really want to get you to Ray so that he can get you a really great presentation. And we would encourage you in the chat, please put who you are. We want to make this interactive. So please put in who you are, what's your business, what's your industry, because that's really going to help Ray in terms of knowing who he's talking to. Because this is a very important topic. And I'm sure Matthew would say the same thing from the chamber. A lot of the businesses that we meet with, when they're really in dire straits, it's because they're not managing the cash flow properly. And it's especially important if you're involved in government contracting, and a lot of other different types of industries. So this is a really important webinar and training that we do. But for us, we're also really happy when we see a lot of businesses, because it means that you guys are taking that first step in terms of kind of understanding more about it. And so I was going to also mention, just thanks to the Miami-Dade Chamber, because this is our third of 3 webinars that we've done with them since the summer. And so far we've already had 120 attendees. So we're really happy with the partnership and with that we're working together. And so we're happy to kind of close out strong. So we want to see if we can do a lot more people for this one. So with that, and I think we have kind of a critical mass so far. So Matthew, I'll turn it over to you if you want to make any remarks on behalf of the chamber.
Thank you, Brian. And I want to welcome everyone to this series partnership with the Chamber and the SBDC Center. As Brian said, this is a very important conversation to business owners. We at the Miami-Dade Chamber of Commerce want to make sure that our business owners are equipped with the resources to be able to grow their business, and understanding the revenues, our cash flow, budgeting, and financial statements at the heart of this. So we are blessed to have Ray here to be able to provide this information. Done some excellent workshops in the past, in our last one. So we're really excited to be a part of this conversation and part of this partnership with the SBD Center. After the presentation, I'll tell you a little bit more about the Miami-Dade Chamber and how we can assist to bring some of the information that you're going to hear today on practical with your business with one-on-one technical assistance. So thank you for showing up. It is good to see that you as a business owner continue to grow in your knowledge. That's the key in order to be able to develop your business to the ideals that you hold dear. And why you're doing this. So thank you very much for being a part of this, and we look forward to the presentation.
And with that, we're going to turn it over to Ray Juncosa. Ray Juncosa is one of our SBDC at FIU financial consultants. He's one of our seasoned financial consultants. He's I don't know if he would say recovering banker or former banker. And he's also one of our more popular trainers. And so you guys are really in for a treat today in terms of the knowledge he's going to share with you. And please, if you have any questions, please put them in the Q&A. And we're going to get to them Ray can get to them at the end. And with that, I'm going to turn it over to Ray for the presentation. Just thanks to everybody for participating.
Thank you for the intro. And by the way, guys, that's just one way of Brian saying that I'm old. Seasoned, right? Yeah, a little.
I'm not going to touch that, Ray. I'm not going to touch that.
Little pepper here and there. But welcome, everyone. And yes, definitely these workshop series are so critically important to small businesses, simply because financial literacy is always a challenge. Everyone gets so involved with the day-to-day, of the business, and they really don't take time to think strategically or really get a grasp of the financial numbers, which is critical, the backbone of the business. And not having a knowledge of that is obviously a major challenge. And at the center, our idea is always to be able to provide ongoing, value-added presentations like this to be able to help the small businesses in a very, let's say, simple format, and and to make it functional, something that you can use immediately. And then, of course, I'm sure you know, as Brian has mentioned in the past, we're here to help you, and we're glad that Matt has afforded us this opportunity to be here. So let me just let me see. Okay, let's go to this this first slide, because this seems to always be, you know, people having a difficulty with mixing up the idea of profit versus cash flow. Okay, because and you know, I'll get a little bit more into it as we move down the slides, but you know, you could basically be reporting obviously a profit at the end of the year and pay your taxes, and then but you be kind of strapped for cash, right? And I'm sure that you all know exactly what I'm talking about. So this is why this presentation is so key, for you to be able to understand the differences between profit and cash flow. So, you know, this is going to be, you know, one of the, you know, primary issues in this presentation. Okay. So, you know, we'll start out with, you know, with some definitions. You know, what is really cash flow? And as you see, there's a statement of summary receipts and disbursements of cash during a particular time, right? And obviously, it also depicts the changes in cash position for a company. So, I mean, this is, you know, the inflows and outflows of cash. We're not at this point in time talking about sales, right? Or bottom line net income, but rather the inflow and outflow of cash. So these are transactions, you know, we look at what increases we're receiving in the business in terms of revenue streams. And then we're looking at what are the outflows, you know, expenses. You know, we have different types of expenses. We have fixed expenses, variable expenses that we'll talk about. But again, this is all about dealing with the actual inflows and outflows of cash, because cash is king. Let's face it. We all know that that's the case. It's great to, you know, say, oh, I've been selling and increasing my sales at this level. But as we all know, you know, those of you that sell mostly on credit, you know, and you're doing your accrual accounting, you're reporting a sale, and then you may be reporting a profit, but are you really getting paid on these credit sales, or would you have your money tied up in inventory, for example, or both? And so so that's important to understand. You know, so profit, as you see in the slide here, you know, we call it net income, and you know, obviously it's a surplus between, you know, revenues, and the difference between revenues and expenses. And then, you know, at the end of the reporting period is what we use to calculate the taxes when you submit your tax returns to good old Uncle Sam, right? But cash flow, you know, it's as it's mentioned there. It's amount available in cash within the business at any given time. And this, you know, this is what we want to look at, right? We want to be cognizant of the fact that the cash is really what we need to concentrate on. And we need to take measures, and we're going to be making recommendations throughout this presentation and tips to be able to improve that cash flow. Okay. So net income is a measure when a company actually made, you know, what they actually reported as profit during a period, right? And remember, again, accrual accounting, it doesn't mean now net profit doesn't automatically mean that you've got cash in the bank. I mean, I've had many times I've had a lot of my, you know, of our clients that basically have approached me and said, look, Ray, you know, I mean, I don't understand it. I don't get it. I did my thing. I grew in sales. I reported a profit and I paid my taxes, but I'm strapped for cash. And it often has to do with what? The operating cycle, what you have tied up in your money that's tied up in inventory and receivables, okay, and prepaid expenses. This consumes cash. So obviously, being able to manage that situation and being aware of it and looking for ways to improve that actual flow or that cycle is important, and we'll talk about that. So obviously, when we talk about financials, obviously you can't ignore what are the financial statements, the key financial statements that we deal with as a company. And, you know, so I thought it apropos to mention it in this slide to remind you that, you know, obviously you begin with what? Your balance sheet, right? Your balance sheet tells us what? What does it tell you? It tells us what you own, your assets, what you owe, your liabilities, and the difference is your capital, the skin in the game. And you know, this statement tells us as lenders, tells us how financially strong a company is in terms of being able to deal with unexpected situations in the future. If you're too highly leveraged, meaning you have a high level of indebtedness, obviously any kind of hiccup can throw you over the wall, right? And obviously, and then you're going to be in problem. You can be illiquid, and once that happens, it's game over, right? So you need to really take time, and I consistently advise that to a lot of small business, to take time and think strategically and grasp your numbers. Don't be afraid. Don't leave it up to one single person. I know a lot of small businesses, they just trust 100% their accountants and bookkeepers or whatever. But I mean, you need to make sure that you understand what's going on. You need to be involved directly in making these strategic decisions when it comes to the finances of your company. Okay, so you need to understand your margins, your profitability, your break even. All these items are so important. And it's not really, look, it's not rocket science. You can do this. You can all do it. And you have at your disposal an incredible amount of valuable information that we can provide at the center in helping you with these issues. Then you have the income statement. It tells you what happens, right? Because I always say that income statement, I always use the term that it's the report card. It tells us how you did, right? What happened. And the same goes for the cash flow statement, which is, because remember, the income statement tells us what? The revenues and less the expenses, and then your bottom line. The cash flow, on the other hand, it tells us, and we're going to talk a little more directly about it. Obviously, we're talking about cash flow. It tells us what are the inflows and outflows from the three different activities, operating, financing, and investing in a business. So it really tells us where the cash is coming from and where it's going. And finally, the ending balance of the balance sheet tells us where you are once you finish the reporting period, right? So critical to understand that. And again, these three statements of the three, surprisingly, a lot of people don't know this, but the cash flow statement, which is used consistently, really just came into being back in 1988. So prior to that, it was strictly the balance sheet and the income statement. Along here. Okay, so here I wanted to provide you with an example. I'm sure, obviously, you've all seen it. I'm not going to assume anything. I just want to take the opportunity to look at this and say, okay, this is the balance sheet we talked about. These are your assets, and this is what you own. As you can see, they're broken down into by liquidity. The most liquid assets first. You have your cash, petty cash, temporary investments, receivable. Notice one thing on this, and I'm making the reason why I'm pointing this out, because I'm going to make a segue into the operating cycle, which will be dealing with cash flow. Is that notice this company, of the current assets that it has, 89,000. Look at this. You've got 71,500. Very large percentage of it is tied up in what? Accounts receivables and inventory. Okay, all right. The rest of the assets are fixed assets, such as land and real estate. And then obviously those are assets too, but these are illiquid assets, right? Okay, and the reason why they're there is because they support the operation of the business, right? And then on the liability side, the same thing. You have the current liabilities, that was a short-term debt, and then you have the long-term debt, and then finally you have stockholders' equity. And if you look at that, you can see that the category retained earnings, this is where all this profit is going, the accumulated profit. So obviously, this company has a stockholders' equity of $289,000. It's an accumulation of profits in the past. So it's important to be aware of that. This brings me to what? To the working capital cycle. This is an area that you as small businesses really need to become familiar with, because this is all about your cash flow, basically, because you have a product that you sell. You have to purchase inventory, right? And then with this, you either, it could be a finished product or it could be raw material that you convert into a finished product. And then how do you buy that? Do you pay cash for it, or do you get a supplier payment for it? Is it a supplier that you're financing with suppliers, or are you financing it with a bank? And then obviously when you sell, do you sell on credit? When you sell on credit, you create a receivable, and then obviously you got to wait to get paid on the receivable before you can have the profit. Okay, so important that cycle, and we'll go over it again. That particular cycle is so critical, because the shorter that cycle is, the more profitable you're going to be. And I often, make the comparison to when you're in the, let's say those of you that are in business of buying and flipping property, you buy, let's say you have a specific amount of cash that you're using for this project, and let's say it's 500,000. You go out, you buy a house, okay? You may use all of it or part of it to purchase the home, and you have to do your repairs and then put the property on the market and sell it. Now, if you sell every 3 months, then that means that's 4 times what you would ordinarily make with whatever spread you're making on the deal. But if it takes longer to sell, obviously you're less profitable. So it's the same thing. It's that working capital and the cash conversion cycle that is so critical in a business to understand and to look for ways to strategize and ways of improving that. And this is what a lot of this presentation today is about. So on the screen, you see an income statement. Again, just for reference sake, this is the one I call the report card. You've got top line revenues, and then you have the gross profit less expenses, and then you have the bottom line, which is the net income. Now, here is a famous cash flow statement that I talked to you about, and you notice that this statement is broken down into 3 categories: operating activities, investing activities, and financing activities. And operating activities where the cash is generated from what? You have your receivable, you bought inventory, and these activities. Notice that these activities, some are outflows and some are inflows. Obviously, net income is an inflow, and then depreciation is a non-cash expense. So there's no money that goes out on that. So that's an inflow. And then the others are a decrease in cash. So there you have a cash position from the operating activities. And then you notice, because again, the cash flow is what? About the cash. So now you're taking cash to do what? For capital expenditures. So that's an outflow of cash. And then finally, on the financing activities is where you're either, let's say, buying an asset, or you're disposing of an asset, and then again it'll be reflected either as an inflow or an outflow of cash. when I talk about, cash flow, I always love to kind of give people the perspective. I know that Brian had mentioned about the being bankable, and we have a great presentation on being bankable. And it's always important to understand how the lenders are looking at you, and what kind of metrics they use, and what kind of analytical tools that they use to analyze your business. And I thought it was important to mention that some of them, for example, comparative financial statements, when you're looking, at the different statements. And common sizing is simply taking the statements and then breaking them down by sales 100%, and every line item there under. This is information for another presentation, but I guess the point that I'm trying to make is, once you do that, once you take your sales, if you guys go and take your income statement right now and you put, let's say you compare 1 year with the next, you put on the top sales in parentheses 100%, and every other line item a percentage of sales. Trust me, it's like a storybook. It'll tell you, because a lot of the things that may be lost by just simply saying, oh, he made money from 1 year to the other. But, it's so important to know what are the differences in those percentages from 1 year to the other. Remember, sometimes a company could have grown in sales and made more income, or let's say it didn't grow, so they made more income simply because they sold some assets. But is that part of the operation of the business? No, it's not. So all these things are captured by these tools. Common sizing the statements, the trend percentages, ratio analysis. I mean, there's like 32 ratios that banks can use. But I mean, the typical ratios are the liquidity ratios, then the debt ratios. And I'm sure those of you that bought a house, you remember your debt to income. The same thing applies for a business. You call it the debt service coverage ratio, where you take the net operating income, and then you want to determine what your obligations are in P&I for a year. And then that way, if you don't hit the specific target of a lender, which is usually at 1.25, then what's going to happen is, that's the ticket to admission. You can't get in unless you can demonstrate to the lender that you have sufficient cash flow to be able to meet your debt obligations. Okay, that's called debt service. And then you have the fund flow statement, which is the same as the cash flow statement. Again, what it is, it's to try to create a sense of awareness for you guys to be able to say, okay, all right, I'm selling, but I mean, okay, what's wrong? Why don't I have sufficient cash in my account? Let me look at my terms. What are my terms on my receivables? Are there opportunities with the accounts payable? And so we're going to talk about that. And here's just an example of a cash flow statement with more specifics and more or less delineating more a breakdown of what's typical in an inflow, what's typical in an outflow, okay, in the different activities. The cash flow statement, always remember 3 main activities: operating activity, investing activity, and financing activities. So, as it states in the slide, a powerful starting point. Okay, so what do you want to do today is to try to motivate you to make a decision to do a better job in managing your cash flow, right? All right. Plan and control your cash flow. Use simple accounting programs. Use suggestions. I certainly hope that most of you have QuickBooks. Okay. Making basic entries daily, your due dates for your payables and receivables. Again, it goes back to the famous operating cycle. That's going to make you win. If you manage it correctly, if you make it as short as possible, trust me, you're going to be much more profitable. Okay. Now, granted, there are some industries where the process is longer, but I mean, when you compare to your peers, you want to make sure that you're performing, that you're not an underperformer as a company. Okay. The cash flow statement and the cash balance, make it a habit to know your actual daily balance. I mean, you need to know where you stand on the cash position of your business, right? This one is very important. Recognizing potential cash flow problems, and then reacting. And actually, I prefer that you try to be as proactive as possible with regard to managing your cash flow problems. But you definitely need to give it a priority and create the strategies. And we'll talk a little bit more about that. And as it states, cash flow basics tend to be plain common sense, and they are. Again, this is your business has what? Your cash in from sales, you have the products that you sell to your customers, you have expenses, vendors, and then in turn, you have to pay whoever financed the inventory back, and then obviously the clients on the receivables have to pay you back in order for you to finally, and then always try to have some cash reserves. Okay, so here are some rules that we like to share with you. Like rule number 1, cash is the most important resource you have. Well, by all means, right? And I think we can all agree that more cash is better than less cash, right? And then collect cash now is better than later. Again, you don't want terms with receivables with clients where basically you're giving them way too long of a period to pay you back. This is a problem, and I'll give you an example of where a lot of growing businesses just failed simply because they thought that they had landed this incredible contract. And for those of you that are looking at government contracting and stuff, be aware that you need to prepare yourself in terms of knowing that the bigger that the client is, what happens is because they're powerful institutions, they will want better terms. And what happens is the longer the term to get paid, what happens is it ties up your money in inventory, right? And waiting and not in both inventory as well as in receivables. So what was happening is your cash is evaporating, basically. And there have been companies that have tried to sell to the Walmarts of this world. They were excited that they had $5-10 million contracts, and they realized that they had to wait 90 to 120 days perhaps, and they didn't think about that. And then so where's that money coming from? The money that you have to invest in the product to be able to get paid, and you have to have the appropriate term. So it gets to a point where, again, a company can simply sell themselves out of business. The moment you dry up that liquidity, that cash evaporates, you're going to have a difficulty getting any funding moving forward. So, I mean, this is why, the cash flow is so critical. So it boils down to what? Using these strategies to manage that cash flow. It's gold. It's so critical. It's the lifeblood of your business. So you should have collection strategies and agreements where you're trying to make it as short as possible. And if you can get by in the same fashion that Walmart is doing it to the smaller vendors, you have suppliers, you can get supplier credit. So, supplier, if you can get good terms from your supplier, if your supplier gives you 120 days and your receivable is paying you in 90 or less, what does that tell you? I mean, you're in a good spot, right? You wanna be in a good spot in that regard. So, by golly, this is why these strategies are are so very critical. And rule number 2, focus on cash flow rather than operating statements and P&L. Yes, like I told you, the income statement, net profit, yes, tells us what you made for the year, but it's, remember, it's accrual accounting. So, I mean, the moment you make a sale, even though you didn't get paid the cash, you reported the sale, you reported the profit, but do you have the cash flow? You don't. Okay, cash flow statement, become familiar with this. Again, you have sources to be able to understand how cash flow statement works and the differences with the income statement, okay? And then you can better identify these gaps and these shortages if you're looking at these statements and saying, oh, wait a minute. Look at all this money that's going out of this particular activity in my business. What can I do to improve that? It's like raising a sense of awareness. So to talk a little bit, just quick terminology, cash flow terminology, cash on hand, start of the month, cash in. I'm not going to spend too much time on this because I want to, and then the cash out, I want to focus more on the critical items. And then obviously you all know fixed expenses, variable expenses. The fixed are, the regular, the ones that you can't eliminate. You got the rent, power, and the sales tax, and then the variable. Obviously, they'll change depending a lot on your activities and sales, right? Very important to understand that. A little bit more terminology. Okay, cash flow. So the cash flow, the amount of cash that has flowed through the business and changes. And then we looked at the cash flow statement earlier, and we saw that of all the 3 activities, we had an ending balance. We had a beginning balance and an ending balance. It tells you what your cash position is. And, the lenders are going to look at that. So the idea today is to say, okay, guys, clearly, I think now you may have a good understanding of what the importance of cash and the differences between net income, profit, and the actual cash. And now, some strategies to be able to improve your particular situation in your company, right? Because we have different companies. I mean, you can't compare a consulting company with a manufacturing company. They have different issues, okay? Or a company that sells a product, a company that has to first buy the raw material, get the finished product before it sells it. Obviously, it's going to need a company like that. The supply chain process has to be elongated somewhat because they need to have the time to be able to finish the product, right? Before paying the supplier. If not, they're going to be strapped for cash. So optimizing your cash flows, we thought in this presentation that provide you maybe with 7 ways to increase cash reserves. Okay. Now, obviously, increased sales fuels cash flow growth. Again, you increase sales, but again, I have to admit that to be able to do that, you got to make sure that you're managing your operating cycle, your cash conversion cycle the right way. I mean, you're going to need to increase your sales, and if you're selling a product, obviously you need to buy inventory. Okay, and then if you need to buy more inventory, then the question is how you're going to finance that inventory, right? And then how long will it take your clients to pay you back? All right. There are many ways, because remember, you have lenders out there that will extend money to you based on your receivables, and we have other presentations that we make when we talk a bit more specifically about receivable financing, so the asset-based lending activities and stuff. But I mean, you always have to be vigilant as a business owner in looking for ways to improve your cash flow, because that is your capability of being able to take on more debt and be able to fuel your sales growth. This bullet item here, re-engineer cost centers, obviously depends on how big your companies are, but the idea is always to look for ways and strategies to improve, be a little bit more frugal about what you're spending money on, and then and what terms you're getting from suppliers. And so it says, you know, beware those who say and company needs more cash, sell much more, customer pays, cash problem disappears. Well, a lot has to do with how you get paid. If you know you're getting paid with credit terms that are far too long, this can create some stress and pressures on your business. Okay. Examples of some cash generators: you open new, shorter, less costly distribution channels. I mentioned that earlier. If you have distribution channels that where you can get better terms, you want to do that. What you look at your pricing. I mean, sometimes, you know, when you break down, if you have, let's say, a large diversity in products, you got to look at which products have better margins and where is there an opportunity to raise prices, right? Sometimes introducing new technology will make it easier to process things. It'll help you pick up the tempo more and be able to take on a larger volume. Right? Gross margin and operating costs. Let me go back to, let me see. Okay, growth always creates new costs for people, cash generators. Let's talk a little bit about that in a second. All right. So growth always creates new costs and people cash generate justify added operating costs. You know, you got increase. You have to be careful of how you manage your operational structure in terms of expenses, right? And so I think you always need to, again, be vigilant on opportunities that you can utilize to be able to improve the flow, lower the cost of operation. Again, some of you have, you know, very small businesses. It's a lot easier to really take a look and analyze and look for ways. And well, sometimes there aren't that many options, but you know, if you're a smaller business and you're selling a product, just simply by maybe improving the terms from that you get from your supplier or the lender that's providing you a line for financing, or maybe sometimes you're better off if you use, let's say, like an asset-based lender. I don't know, some of you have heard of the concept of factoring, where you can use a factoring company that will actually advance money on your receivables. Now, you know, the big difference between accounts receivable financing and factoring is that in the case of factoring, the factor, which is the company that advances you the cash, will actually end up owning your receivable, okay? And I mean, in those cases, some companies may have some difficulty with that because they don't want their client to know that now another company owns their receivable. But the reality is, it's a way of being able to advance on an invoice that's 120 days and get paid, you know, within immediately, just by presenting it to the factory. All right. And then looking at your financing costs. I know I've heard some real nightmares with some of these cash advance companies, these predatory lenders that will just kill a lot of small businesses. And then once you do that, it's like napalm. Those of you that I'm sure not many of you lived through the Vietnam era, but they used napalm. That stuff, once it fell on your skin, you couldn't get it off. And it's basically what happens with these cash advance companies. You know, you have to be very careful. The interest is very high. It's onerous, and it'll, you know, almost makes it impossible for you to repay the loan. Looking for ways to reduce interest rates, and there's a lot of items that are connected to this. Because remember, there's an inverse relationship between credit worthiness and the rate level, right? The higher the credit worthiness, if your credit is good, the lower the interest rates are going to be. So that's why you gotta manage your financials in a very critical way and give it a lot of priority, because that's going to help you fuel the growth in your business. In the event of sales fall off, what would be the least painful operating costs for the sacrifice? So it's again, raising a sense of awareness. Again, these are all kind of suggestions to overcome the issue of shortcomings on cash flow, watching your overhead costs, always negotiating on price. And when you give credit, it says give credit very carefully. It said if you were to present yourself to a bank, let's say you want to receive financing, I'll tell you what the bank does. The bank looks at the receivables and says, okay, here we go. So of these receivables, how many are over 60 days? Or 90 days, whatever their criteria is. Anything over that, they're going to say, we're going to carve that out. We can't advance you on that. Then they'll ask you, of these receivables, how many are past due? How many are delinquent? Okay, that portion has to go out. That's why when you go to a bank for receivable financing, they ask you for an aging report on the receivables, an aging report, to see what kind of aging you have on these accounts and who's paying, who's not paying. They want to remove it. And then finally, if you have someone with high concentration on your, let's say if someone makes up 20, 30% of your total receivable, obviously that's called concentration risk in terms of, as the lenders see it. So you need to understand that. So they may not advance on that amount that is specified under this particular client, unfortunately. It's just, and then you remember, the banks are in the business of risk mitigation. They're not interested in taking your assets. Although, many years ago, they used to draw the image of a banker with a long top hat and a long mustache, right? An evil looking, sinister kind of guy. But the reality is, banks are not in the business of taking over your assets. And once they do, it's a difficult journey for them, because they have to turn around and get rid of it, and then in the process maintain it. And I remember the nightmares of the financial crisis of 2008. It was horrible. A lot of banks that were inundated with non-performing loans, and it was horrible to be able to manage it. And a lot of them were going at very high discounts. Okay, so I remember going up to Orlando with investors and looking at what today is a $500,000 condo at $25,000 a door. That's the reality. So, and it's all about, again, it's financial management. That's why all these financial literacy trainings are so critical. And obviously, this cash flow presentation and a better understanding of cash flow and looking for ways to optimize your cash flow with these recommendations is critical. Collect. Well, you got to collect aggressively. If you're out there giving credit and they're taking forever to pay you, that's a tremendous burden on your business. And your receivables, analyze. I don't know, some of you may have a process with how do you manage this situation. If you make a decision on giving someone credit, I mean, what are your procedures in that regard? Is it a credit application? What are you doing? Okay, and then terms and conditions, and have an organized system in place to advise a client that, look, you owe this amount. And then you have a follow-up system, make sure that you get paid, that you get paid on time. Because remember, the longer it takes, the more of a burden on your cash flow. That cash, the moment people delay on paying, your cash flow is evaporating. Okay. Consider discounts for better prompt payment. Yes, I mean, you may have products that you have a good margin on, and then you have some good clients that take advantage of discounts that you provide them, but The good thing is, instead of getting paid in 60 days, you get paid right away. So it's worth it. But I mean, you got to go through that exercise. Okay? There we go. There we go. All right. Reducing days outstanding. It's a formula that's used. Know the chain of approval for payment with each customer. Again, these are all, it's like breaking it down to, as we go back again to the operating side. You're gonna look at your payables, you're gonna look at your receivables, and you're gonna look for ways of improving the situation, right? You wanna make sure that, you have delinquent customers, you need to, to address that issue, okay? And understand what's going on, okay? I mentioned factoring before. There are factors out there. There are certain industries like the trucking industry that use factoring quite a bit because these are companies that need to get advanced right away because they have a lot of expenses, gas and repairs and stuff. Your inventory, which is another one of the, obviously your current assets that we looked at in the balance sheet. You got to find out what it is that you have in inventory. You might have some items that are slow moving. You may need to do some sort of sales promotion and get it out of the warehouse, right? And manage your inventory flow, your first in, first out. Negotiate just-in-time contracts. This is, there are companies like, I think the Amazons of this world and others that's why they have so much cash, because you put an order through and already, they'll go ahead and buy that the moment you order. So that merchandise is not even sitting. It's not even sitting in the warehouse very long. It's gone, right? So, and this concept of just in time was introduced many moons ago, back in the 80s by the Japanese. And again, keep as little inventory as possible. I told you, inventory sucks up cash, right? And if you tie up your money in inventory, it's a problem. And then again, on the payables, the opportunities there is negotiate volume discounts, credit terms. Remember, the suppliers are interested in selling to you, right? So, okay, did I lose this?
Yeah, we're here, Ray.
Okay, good. I'm sorry. No, my presentation was acting up a little bit from my point of view. Okay, so negotiate volume discounts, negotiate credit terms, pay with a business card, bartering. Wherever it's applicable. You're exchanging one product for another as payment, right? Use leasing rather than buying. Again, some of these items may not apply to your business. The whole issue of leasing equipment. Those of you that are more capital intense may find that leasing is a better vehicle. But again, it's trying to make it as simple as possible. It's about taking the time to look at your situation financially, look for these opportunities that are afforded to you to be able to improve your cash flow. Okay, the more cash flow that you have, and these are some ideas on leasing equipment stuff. The more cash flow you have on hand, obviously, the more appealing you're going to be for the lender, right? Remember, equipment at the end of the day depreciates. So anyway, I hope I'm within time, Brian. I'm trying my best to
yeah, we're at 10:50, so we still have time for questions. So it's okay. You're doing good as always.
After here, business processes are how things are done within a business. Successful business understand the need to continuously to improve their business process. Take the time to analyze and please look at that operating cycle. Remember that operating cycle, the cash conversion cycle, the moment that you buy the inventory, How do you buy it? What terms am I getting? What are the suppliers giving me terms? Can I improve that? Okay, and then, okay, I sell my product, I sell on credit. What terms should I give these people? All right, am I getting paid? Is it taking too long for me to get paid? And what can I do to improve that situation? Maybe offer these discounts to get paid earlier, or maybe I can use a factoring company to get paid in advance. Let me look at my margins to see where I have an opportunity to do that. So it's all, it's taking the time. In the same fashion, you take the time to talk to your clients, to be out there, to sell your product. You need to, give valuable time on the financing side. And then, I know a lot of you use some accountants, and then I've had the situation, I'm trying to help clients, and they're still waiting for their accountant to provide them an updated current profit and loss statement. I mean, that to me is unacceptable. I'll be honest with you. And you're the one that's suffering. So, I mean, these are things so the more you are in control, because if you're carrying your QuickBooks and stuff, and you have all your information that you can see it on a monthly basis and look at it and analyze it, then you can provide, when you have a lending opportunity, you can provide the P&L right away and say, look, this is where I'm at, whatever. I'll go ahead and provide you with my tax returns, et cetera, that type of thing. But I mean, if you're unprepared on managing your financials, and you're just not available, it's not available on time or whatever, it doesn't create a good impression, and it makes it difficult to get you where you need to be. Okay, so there you have it, right?
Cool. And then we do have, let's see, let me check. We have one question in the chat, Ray, from Donna, who was talking about, can you talk about using measurement tools when increasing marketing?
Okay, when increasing marketing, well, I mean, okay,
like financial measurement tools. So kind of like some of the.
Well, going back to managing if you remember, advertising and marketing is very directly related to what you're selling, what you want to sell or whatever. So obviously, in that particular case, you need to be able to break down, okay, what are my sales projections for a particular product? What do I need to market that particular product? And what is the relationship of the cost of that marketing tool in relation to my profit margins on the product that I'm selling? Okay, so I would look at that. What is the cost? I mean, you don't want to take on any contract or agreement in marketing with a third-party vendor if the cost is too elevated, and it's going to bite in a bad way into your profit margin. So you need to understand what the relationship is and how far can you take it. So measuring the relationship between the expense to the margin of the product, I think it's a very good beginning.
But I also think, Ray, isn't that where budgeting and projections come into play? Because marketing is not necessarily just a one-off thing. A lot of times to see results, you need to have it be sustained or over a period of time. So it's one of those things too, where you do need to kind of have a handle on the overall financials so that you can actually kind of do some sustained marketing to get consistent clients in the door.
Yeah, absolutely. But again, you need to continue to grow your sales and revenues. But I mean, in the process, I'm talking more about managing your expenses. And yes, so it's all about, as you mentioned, budgeting and making the right projections. But it's really looking and breaking down what these items are going to cost you.
Mm-hmm.
You do a marketing budget. You obviously need to understand what will you need to be, what percentage of sales growth is going to cover the cost of that, right? Mm-hmm. And then, what do you expect to attain by using this particular strategy in marketing, right? But I mean, it's all about, your revenues and expenses, and when you make your projections, make sure that they're credible, that you've done the research and analyzed what the breakdown is of the cost and how it relates to the revenues on the products that you're selling.
Mhm. Definitely. If you had one last thing I know you had your afterthought. Was there one thing that people can do regarding managing their cash flow? Is there something they can do to take away or do today to help them out? What would be that one thing?
Yeah, I think it's just, you know, that you see that little guy sitting there and pondering and questioning. I think you need to set aside time to look at your financial situation, to look at your revenues, to see, the margins that you're using, what the expenses. Look at that operating cycle.
Mhm.
Look at it and say, okay, is this optimal enough for me? Are there some opportunities for improvement here? Am I using a supplier that's making me pay in too short of a period of time? Can I negotiate with them to extend the payment? Maybe if I buy a bit more, will they extend the payment? Let me look at your receivables, look at your payables and your receivables, look at your operating cycle, and look for ways to make it shorter. And remember, Brian, we did one quick presentation on the operating cycle. So maybe this is something that maybe in the future we can present here at the chamber if we want. I mean, but I think that.
Yeah, I think that's a great one. So we can look into that. Well, I just want to thank you, Ray, for the presentation. Matthew, I know you have a couple of closing remarks on behalf of the chamber. I think you also have something to share. So Ray, if you want to take down your slides, and then Matthew could share too. So cool.
All right. Again, I want to thank you, Ray, for really going into detail about cash flow. And a few things that I love that you emphasize is that cash is king. Number one, be clear about using credit wisely. Don't just give away your services and businesses. And just make sure you take the time to manage your cash flow. That last point is the most important thing. Is really, as business owners, you have to take the time. I know a lot of times during the business, we're just focused on, hey, I got revenue coming in, I got expenses going out. But I sit with business owners so often when we actually go through those profit and loss statements, and they're just floored about how much money they made and how much money they spent because they don't really take the time on a regular schedule to really look at that. And it is, as Ray said, it is extremely important in making decisions on your investments, on how you want to move. Understanding your cash flow is one of the most important things about business. And I'm glad this ended this series. We first talked about financial statements, and then we talked about budgeting and projecting, and then we closed out with managing cash flow. So thank you, Ray and Brian and the whole SBD Center team for really partnering with us to go into detail about managing your finances. For those that are interested in the chamber, we are the Black and Minority Business Chamber for South Florida, Miami-Dade County. Been in existence since 1974, and our focus is on helping business owners have their business infrastructure in place, and understanding their certifications, their financial infrastructure, HR, and those type of things, and also helping them scale and grow by securing government contracts. We do this primarily through our one-on-one technical assistance that we provide. So you can always go to our website, www.m-dcc.org, go to our services, technical assistance, and schedule a one-on-one time with us. What we do during that time is that we can take the information that you heard and you learned today and help to put it and make it make sense to you for your particular business. It's a very enlightening sessions that we are able to have. And also we're a clearinghouse for resources and information. So if we, after those technical assistance sessions, if we see that you're going to be best helped by the SBD Center, we're going to refer you to the SBD Center or to the Beacon Council or to Career Source or to Miami-Dade County or all these different places that have plenty of resources for you. So I would strongly encourage you to take the time to schedule one-on-one technical assistance so that we can help you. one of the most important things that we've done since being a part of this chamber and since the pandemic hit is our small business meetup. If you just want to learn, meet up with other business owners, if you want to hear about the latest resources on a week-to-week level, if you want to practice networking, your pitch, or you want to get referrals, I would strongly encourage you to go to our events page and sign up for our small business meetup. This is one of our most powerful initiatives where we give business owners the opportunity to really create that space to network, share ideas, share resources. We have small business owners that just started to business owners been engaged for decades, from a small one-person business to over 25. We have a really good diversity of business owners, and you're destined to learn something. So I strongly encourage you to be a part of our small business meetup so that you can learn more. We do quite a few events, and we have committees where our business owners who are experts in their field come together as teams to really build upon what they believe is important. And our Health and Wellness Committee has recently started a series called The Business of Health to make sure that entrepreneurs have a very clear understanding of making sure they have the mental, physical, and spiritual health together. So next week, we're going to have a guest speaker from Ghana, a mental health advocate, talk about mental health stigma. Another event of our one of our committees is our Women's Business Council, where we're sharing knowledge between generations, where we have local women millionaires sharing how they made their first million, how money mistakes they made, money moves they wish they would have made. And on October 7th, we're going to have the last session in this series called Being in the Right Room. So I would strongly encourage you to check it out, be a part of this so that you can network and meet with others and learn from others. And then finally, we have our golf tournament. As you know, a lot of deals and major deals are run on the golf course. And we have one of our longest running events. It's the 30th annual Dorothy Baker golf tournament. And we'll love for you to be a part of that, to network, sponsor, and just really engage. That's who we are. We're Miami-Dade Chamber. We all have a lot going on, but everything that we do is to make sure you as business owners are successful. That is the complete focus of our organization. The more successful you are, the more bragging rights we have. So we want to make sure that you're shining, you do what you have to do. So I want to thank you for being a part of this to continue to grow your business, because as small business owners, you lay the foundation for this country. You hire people, you create legacies for our communities, and you literally change the face and fabric of this world and this community. So we want to thank you for continuing to grow in what you do, and we're here to support you in being successful in that. So thank you, Brian, Ray, and the whole SBDC team for really dedicating so much time to help our small business grow. We really appreciate this partnership, and we want to continue it.
And thank you to you, Matthew, and thank you to the rest of the folks at the chamber. And say hi to Beverly. She's one of my favorite people. She's awesome. And just thanks to you guys for the partnership on that. We will be sending follow-up email with the link to the video for anybody that wants to watch it on your own time. Maybe you just miss hearing Ray's voice and you want to hear it kind of again, so you can do that. And just feel free to follow up with either us or the chamber if we can provide you any more resources. Like we said, we're very collaborative. If you can benefit from the chamber, we'll send you to them. If you can benefit from SBDC or any other resources, they'll send them out. So it's very collaborative, and there's enough small businesses for everybody. So before we close out, Matthew, Cheryl did ask, do you have to be a member to join the chamber trainings or other events?
For our events, you do not have to be a member. We'll strongly encourage it, but you can just join in. And we want you to be a member when you feel comfortable. Our membership level starts at $275 for small businesses on the annual level, but most of all of our technical assistants are free to Miami-Dade County businesses. Our small business meetup is free to any business. Majority of what we do is completely free and open to that, but when you become a member, there's another level of benefits that we can provide. So just reach out to talk to us, and we'll connect with you, but there's no membership to join our small business or get technical assistance. So come on down, and we'll love to have you.
And Cheryl was asking, I guess she's in Monroe County, so she was asking, but I guess you guys are open. You're Miami-Dade Chamber of Commerce, but
Yeah, join the small business meetup at the very least. It's on Zoom. That platform is valuable based upon the people that are there. So just join in, bring your expertise. You may get some referrals. Somebody may need your services. So join in and see what's going on, and we'll take it from there.
cool. Sounds good, guys. Well, everybody have a good rest of the week. Thank you to Matthew in the chamber. Thanks to Ray, and just take care.
Thank you.
Take care, everyone.
Bye.